Greetings and welcome back to the podcast. This episode we are joined by Mr. Dane Gregoris, Managing Director with Enverus Intelligence Research, a subsidiary of Enverus, an energy software provider with annual revenues of approximately $500 million. Mr. Gregoris joined Enverus in 2014 with previous work experience at GLJ Petroleum Consultants and Encana. In his role at Enverus, Mr. Gregoris advises both corporate and institutional clients on strategic investment decisions and is frequently quoted in major media outlets on North American energy topics. Mr. Gregoris graduated from Queen's University with a degree in geological engineering and is a CFA charter holder. Among other things, we discuss inventory scarcity, the importance of data quality, and how AI is helping decisions in the energy sector. Enjoy. This episode is brought to you by Galatea Technologies. Galatea is a software company based in Calgary that is focused on helping producers better manage their fluid logistics. Galatea enables field operators and truck drivers with the ability to make the optimal decision on every waste, water, or clean oil load, resulting in 20% savings on trucking and disposal costs. The Galatea platform makes it easy to create digital truck tickets, manifests, and shipping documents that automatically flow through the field data capture and finance systems. Galatea's platform is used by over 50% of Canadian producers, 600 trucking companies, and hundreds of disposal locations. Visit GalateaTech.com to learn more about how to optimize that last line on your lease op. This podcast is sponsored by HeadRacingCanada.com. In partnership with four-time Olympian Manny Osborne Parody, HeadRacingCanada.com is now offering free shipping on European factory performance ski gear. By passing brick-and-mortar savings on to customers, HeadRacingCanada.com offers the lowest pricing available in Canada. Check out HeadRacingCanada.com for more info and get your new ski gear for the season. Good afternoon, Mr. Dane Gregoris. Thank you very much for doing this. I appreciate your time. I know it is valuable, but like I mentioned, anyone that Jamie Hurd recommends is probably a good idea to follow up on.
Yeah, it's a pleasure to be here. And yeah, Jamie definitely is one of the sharpest folks out there that I know and across our client base as well.
To start from the top, what is Enverus for the listener?
Yeah, it's a great question. So Enverus today is the largest energy dedicated software as a service provider in the world. Last year we crested $500 million in revenue in terms of ARR, or annual recurring revenue. Our business is dedicated on the energy industry, but pretty diverse in terms of its customer groups. So we sell services and products into customers as diverse as solar developers in Europe to oilfield service companies in Midland, Texas, as well as E&P companies in Houston, Calgary, Denver, and even institutional investors in New York City. And the thesis is we have about 1,800 people on staff, and we're all building products and services to help our customers run their businesses more efficiently and make better decisions in the energy space.
How does Enverus make money?
So we sell software products, research products, analytics products. So a lot of it looks like a subscription to a platform or service or research distribution panel. Almost all of our revenue is through recurring revenue.
So if you were to explain it to your grandma, when somebody signs up for the subscription, they pay you monthly a fee.
Pretty much, yeah. That's effectively how it works.
Every month you pay for the use of the software and you subtract your costs off that. And at the end of the day, you have profit, which is how a software business works.
Exactly. I think it's a little simpler in terms of the P&L than maybe like a lot of energy companies where it is simply just kind of revenue less costs.
The great thing about software is it's a high margin business, not as much fixed capital goes into it. So it can be lucrative.
That's right. Yeah. And it's been a kind of a wonderful place to work. It's been a growing business, both organically and inorganically. And certainly our handful of different, private equity sponsors that have been involved in the businesses from one way or another have done well.
To go back in time a little bit, how did you get into energy and why?
Yeah. So energy was something that sort of crossed my mind in university. So I had a affinity to study sort of natural sciences in university, always sort of just interested in natural sciences and why the world was the way it is today. And, through that sort of soul searching, found that There's a lot of opportunity in the energy space, and it was certainly an interesting place to marry natural sciences as well as sort of business acumen, which is another one of my interests. And so through growing up in Ontario, I didn't necessarily get a lot of exposure to the energy sector, but through university and through an internship at Encana, I was able to really generate a passion for the business, and I found it to be a very exciting place to be.
That's a rare career path for some out east, especially nowadays, identifying energy as a space with opportunity. Did you think of it that way before you came out here? Or?
Yeah, I mean, I think when I was at school, there was definitely different economic times and maybe even political times. So it was kind of viewed as a pretty dynamic and even potentially lucrative place to build a career. It's been certainly rewarding from a number of different factors. You know, the market's been difficult over the last 10 years, especially if you exclude the last couple. But it is just sort of this like ever changing landscape, and certainly that's lived up to all the hype.
Calgary is a great city too. It's affordable, a lot of opportunity. So
absolutely, yeah. It's been better than my expectations moving out of here for sure.
Well, maybe we can touch on the markets to get things going. Today is April 9th. Oil is around $86, but maybe do you get your thoughts on oil? Why has oil been going up?
Yeah, I mean, I think there's been pretty interesting trading action in the last couple months. You've had a lot of strong demand data out of the EIA kind of weekly reporting. So the US demand number has been really strong in terms of fuel consumption. I also think the fear around supply, particularly in the US and globally, sort of outpacing demand near term has really been quelled by data that sort of suggested that it's tapering off, not accelerating. So we had sort of accelerating US oil production in the third and fourth quarter of last year. And that rate of change has slowed considerably to more of a flattish number. And so that's certainly a sigh of relief for the oil market that we're not going to see sort of climbing US oil volumes. I'd also say OPEC has remained relatively true to its word in terms of cutting production. We've also even heard of additional cuts out of Russia that also kind of add to the constructive backdrop. So a couple different factors, but certainly in a better place than we were a few months ago.
On the flip side, natural gas it's been tough. Under $2 the last few months. So why has natural gas been weak? And although it's up today, what's the reason from your perspective?
Natural gas has been pretty awful, I think, for a producer's perspective over the last 6 months or so. A lot of that has to do with really strong supply growth, particularly in the US. You know, there's a few key infrastructure projects that push supply higher than folks' expectations. It's been a warmer winter on just a average heating degree day basis. And I think, you know, both those factors have sort of created an oversupply effectively. So inventory levels are well above the 5-year average, which usually is bearish for price. And so we really need to get out of this year, start building demand, or having these big LNG terminals get into service to sort of destock the natural gas inventory base. And we should see higher prices into next year.
Are you expecting higher prices?
Certainly we expect higher natural gas prices in 25 and particularly in 26. So we have a pretty optimistic view on nat gas here. We think it actually gets, in terms of Henry Hub, to get close to $4 to $5 per MMBTU. So that would be a pretty good trade if you put that on now. And so it's a good time, I think, to be thinking about, you know, adding exposure to the nat gas space.
The trends you're seeing across North American E&P, one of them, like we discussed, was inventory scarcity. How does that impact oil and natural gas? And what do you mean by inventory scarcity?
Yeah, it's been a big trend over the last couple of years. A big part of the research we do at Enverus is coming up with kind of quantifying the remaining locations across major basins in North America. That's probably what we're known best for. And so we make a very concerted effort to have a very kind of granular answer to these types of questions. So it's probably the number one topic that we speak to from our producer client standpoint, as well as our institutional investor client standpoint. And I would say when we look at U.S. basins, particularly the more mature U.S. oil basins today, so think like the Bakken and the Eagle Ford, DJ Basin, there is a degree of high quality inventory scarcity in those basins. in our calculations, we estimate those basins really only have 5 to 8 years of remaining resource at today's sort of capital efficiency. So there are locations to drill beyond 5 to 8 years, but it's just going to look worse. So when we look at the break even of those locations, we think sub $50 break even WTI locations, you only have about 5 to 8 years left in those basins. So I would call that inventory scarcity. If you're a producer levered to those basins, you're starting to look at acquisitions to backfill inventory. And we see inventory scarcity as driving a lot of the decision making from an A&D or M&A side in the space.
How do you factor in the undiscovered or the probable? How do you think about that when you're talking to clients or companies? How does that discussion unfold?
I mean, I think it's real for sure. You can make an assessment of inventory at a given point in time, but you don't know what's going to change. What I would say though is over the last couple of years, given high inflation across oilfield services due to higher commodity prices, as well as productivity per foot across major basins across North America starting to decline, we don't have the same low-hanging fruit to ratchet up completions and find new ways to extract resource. There's been a few examples of it. I mean, the Clearwater is a great example in Canada where a new design or a new methodology to extract oil is more economic. But in the US, frankly, hasn't been a lot of levers that operators have pulled to prove up tier 2 resource and move it into tier 1. So most of the time when we're revising our inventory estimates, they actually go lower year over year. And that's been the case for the last 2 basins we've looked at this year. So because productivity is getting worse, it's harder to make an argument that, the resource you're going to discover, which you definitely will in some of these basins over the next few years, is going to be better than what they're drilling today. It's probably going to be discovered. It's just going to add to the, call it $50 to $70 break-even resource, which we think there's plenty of. It's just not as good as what most of the industry's drilling today.
Sometimes technology gets better. How do you factor in going into old plays and old wells with better technology? Is that something that you think about? How does that impact your evaluations of basins, the fact that technology is getting better?
For sure. Yeah. I mean, I think the best way we do that today is through analogs and case studies. So we'll look at a given pad or what an operator's done in a specific section and see if we can extrapolate that data sort of across a different set of resource or within a reasonable range of geologic continuity. And we use that to inform a lot of the inventory work that we do across North America. However, does it account for big step changes in that new technology? No. So it's really just at the margin. Hey, we think an operator can do this based on what they've done before and based on a new technique they're employing in this pad. So I think we capture maybe that first degree of technological change, but the big step changes are certainly out there and possible to surprise our estimates for sure.
Are you seeing more institutional money looking at energy nowadays, or is it still tough?
That's a good question. Yeah. I don't think we've seen the rise in, like generalist dollars flowing back in a massive fashion. I would say it's building, but from a low base. And I'm speaking from a relatively kind of narrow set of clients that we speak to on a regular basis. We tend to, our products are very technical and sort of E&P centric. And so it tends to find a better kind of product market fit with alternative asset managers, whether those are hedge funds, private equity funds, credit funds. They tend to want to go deeper than say a mutual fund or, a large generalist fund that wants to allocate a sleeve into energy. So I would say the specialist base has grown over post-COVID and the generalist base has grown somewhat, but it's still not. Tech still is very much the focus for I think most generalist PMs as it moves the market just a ton.
How do you see AI impacting traditional energy? That's a pretty big subject. You could, I guess, start from what Enverus offers, but what are your thoughts on that?
Yeah, we think AI is super exciting.
Where do you start?
There's a lot of different ways you could think about, employing AI in terms of whether it's operations, whether it's software services, improving software services, whether it's, collaboration, I think the easiest things that we can point to as a software provider are just enabling a better client experience. So you can imagine if you ever use like enterprise software, it tends to be complicated. There's a lot of different use cases with a lot of the software that we generate. And so an easy way to make something go from maybe medium user-friendly to very user-friendly is adding some sort of text box feature to allow you to interact with a complex software by asking a question, similar to how you'd ask, Chat GPT questions. So that's sort of one thing we're working on that we're sort of excited about is, just enabling better customer experience, leveraging large language models, and also being able to dig through 20 years of research very quickly using a large language model rather than traditional search functionality. So there's a few kind of easy wins, I would say, on our side that we're excited to be working on and to be enhancing a customer experience. And then I think the other thing that our clients are very focused on, whether it's on the corporate side and investor side, is what is the impact of AI on energy demand? It was probably like the real hot topic coming out of CERAWeek. It's been building momentum, year to date. And you could even look at, some of these independent power producer share prices through the US. Certainly people are excited about the prospect of growing power demand in the US for the first time in a long time. And our estimates is that you will grow power demand based on some assumptions around AI adoption and data center build out. Ultimately, because these data centers need, I think, what they call triple redundancy, where you actually need power full on 24/7. It can't be only an intermittent resource that you're using to power. So we think power demand goes up. It also ultimately means better nat gas demand towards the end of the decade, and million different variables that get us to where we expect. But we think it's around 5 BCF a day of upside on our original power demand estimates or power burn estimates for nat gas in the US by the end of the decade.
Just a quick thank you to one of our sponsors, and we'll be right back to the show. This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. In traditional energy, the point is to drill wells and produce oil and natural gas. So with AI, how does that help that process? Is it figuring out the best places to drill? Is it figuring out better optimization, drill speeds? What's one example for traditional energy other than what we discussed?
Yeah, so something that we've been using a lot of over the years is kind of leveraging AI or machine learning to be able to extrapolate data. Right. So a lot of what AI does is can enable you to throw a bunch of data into a system and it to tell you what causes or what levers an input data has on an output data set. Right. So you could imagine putting in a bunch of well data in terms of productivity into a big model and then adding a bunch of completion data as input data into that data lake, if you will. What we've been doing for years is helping clients kind of leverage those workflows to say, okay, the model is saying that completion intensity is the most important variable that drives productivity per foot. So then you can optimize and you can really dial in how much completion intensity is going to improve productivity. And you can find that marginal return for a given input of intensity. So that's an example. There's the great part about oil and gas is there's so much data. And there's an insane amount of variables that you can try to quantify. And so whether it's a geologic variable, completion variable, there's a lot of different ways that you could use some of these higher end analytics programs to ultimately get you a better answer.
Is it working now? Have you seen results?
I would say,
does it work?
Yeah, I think it does. I think it enables you to get an answer very quickly. You may have come to that same answer spending tons of man hours. And I think what we've seen, particularly post-COVID, is that E&P companies specifically, to speak on the sector, have grown in terms of asset bases. They've grown in terms of cash flow on the back of both oil prices and gas prices being higher, but it also on the back of acquisitions. But they're running with the same lean teams. And it's incredible the difference in terms of headcount, per BOE that this industry is running with. And so one of the things we point to is they're all, being pushed to do more with less. And so the, teams and teams of land people, geologists, engineers that these businesses used to have are now being run by very small groups that are leveraging technology. And so I think from just a pure G&A per BOE standpoint, it's been a home run. I would say from an insight standpoint, I think you would have gotten to similar answers just with the amount of data you have.
I see.
It would just take so much more time to parse through.
In simple terms, if you go back to school, the old saying was garbage in, garbage out, where if your data isn't good, you won't get a good output. Has it been difficult to get quality data to put into the models?
For sure. Yeah. It's a big challenge. A big part of our organization, and we sell a lot of data, is cleaning up data that's reported to the regulatory bodies across the provinces and states in North America. So it's an enormous lift, and it's a big part of the effort is to get to a point where you can actually feel good about it, to put it in a model and get outputs that make sense. And it's always a lot of the discussion, I would say. Once you come up with an output based on data, you're always asking and sort of second guessing, well, if we clean it up and look at it this way, it tells a different story. So 100%, that's a big part of the challenge. And despite, I think, the industry just overall getting a lot better with data, and more data kind of provides you with a little more comfort, right? If you're making a decision based on one well, right, the statistics aren't really in your favor if that well's data is not very certain. But if you have 100 wells, you have one or two wells that the data is wrong, it's less important. So the more data, I think, across industry has sort of helped people sort of de-risk that problem. And also, I would say just the ability to sanity check stuff very quickly using higher end models or software. It just enables that. When I started in the research business, we were pulling everything from a data platform and doing everything in Excel. And now so much of the job is you can operate in software. It's just so much faster.
The idea is that you can come to the same answers, or maybe even a better answer, with less people and quicker with the software, maybe.
Yeah, I think that's a good way to do it. Yeah, a good way to frame it.
Advantages, disadvantages, similarities, differences between Canadian and U.S. E&Ps. I guess, what are the similarities and differences?
I think it's a super interesting time. There's more and more cross-border discussions than ever during my career, doing this. I think the differences are pretty stark, to be frank, in terms of resource life. So my point earlier on, the resource life in some of these mature basins in the U.S., you extend that into the Permian with over 50% of the capital in the U.S. going to the Permian today. We think on average that sub 50 resource life, sub $50 break even resource life in the Permian is about 9 to 10 years. So it's better than the Eagle Ford, Bakken, DJ, but it's not that much better. It's not an order of magnitude, more deep. And I think when you look into Canada, you all of a sudden have this, duration of resource that a lot of US operators can't compete with. So from an apples to apples duration, or how much inventory a given E&P has in Canada versus the US, I would say on average, a Canadian operator usually has twice as much inventory in terms of years. So the resource disparity between the two is probably most interesting. For the most part, they trade at similar multiples. So you're buying an E&P company in Canada, buying a US E&P company, and obviously there's differences between the two, but I would say on average, they trade similarly, but the Canadian operators offer, maybe 2x as much resource life to backstop it. So it would argue for cross-border M&A at some point. And I know a lot of folks are talking about that. To be frank, when we're in Houston talking about Canada, I wouldn't say it's top of everybody's agenda quite yet. But when we're in New York talking to institutions, they are certainly bringing it up, and they want to hear about the Canadian E&P space more so than they've ever been in for the majority of my career.
coming from an institutional perspective on Wall Street, we've talked about the fact that there is renewed interest, but at the same time, do you sense that there is concern over the politics and that it's just a kind of a risky political environment, or does it matter?
They definitely still view it that way.
There's concerns.
There's definitely concerns from a regulatory and political landscape, whether it's carbon taxes, whether it's approval of new pipelines, right? Like those are always the biggest questions we get. I think if you look at polling numbers, that's certainly supportive of like a lower regulation in the future than current. So people look at that and get a little bit more constructive. But in general, I do think it's viewed from that perspective, negatively versus the US, where, there's just less barriers. You and I could find capital and start drilling wells in the Permian Basin in a couple months. It takes a lot longer from a lead time in Canada. And there's always the question of ultimately getting market access for your molecules.
There's a lot of noise in the markets. Everyone's always giving you their opinions on whether oil's going up or down, natural gas is going this way or that. But are there particular sources of signal that help you determine oil prices and natural gas? What do you look at?
We have a team of experts that sort of look at this on a daily basis and maintain our price views. And, they look at a lot of fundamental data. So whether it's inventory data that's put out by the EIA, the Canadian Energy Regulator, Alberta Energy Regulator. So we try to stay in terms of primary data sources. And that tends to be from government bodies. It still can be noisy, don't get me wrong. And that's when you need to rely on sort of experience in terms of determining the weekly numbers in the EIA all of a sudden go wonky. You're not, changing your view too quickly. So I would say those are the data sources we rely on most. We also look at flow data in the US, pipeline flow data, and that sort of enables you to be able to say, hey, they are shutting in production. We've seen more than 8 BCF a day shut in the US year to date. So there's been that sort of constructive from a price standpoint. Folks are doing what they say they're doing in terms of curtailing volumes. So there's a handful of data points that we look at near term. And then longer term, it's really the discipline of maintaining models and tying those models to real data. So whether that's building an oil demand forecast, coming up with sort of demand estimates by country across the world based on reasonable amounts of energy consumption per GDP, or on the gas side of, understanding the supply and the really at what price do producers go back to the drill bit and start drilling wells. Our economic model should tell us that effectively. When there's a certain hurdle rate in the industry, maybe it's 50, 40%, you're going to expect folks are going to put tons of capital to work. And so that's what we use to inform our views.
Well, the flip side of that is information overload. Nassim Taleb would say sometimes people have too much information. They end up making the wrong decision. How do you prevent that being in a software information business? It's a complex system and you don't end up with a worse result.
100%. Yeah. We talk about when we're coming up with conclusions in our research that it's very easy to find yourself in a rabbit hole where you're trying to uncover every stone and come up with different ways to prove or disprove your thesis. And with the plethora of data out there, it's easier now to do than ever. So totally can level with that point. I will say, like, when we think about our business, really that's what our research team is there for. So we sell tons of data and software. That's the majority of our business today. The vast majority of our business is on the software side. And a lot of times when companies come to us, they like the software, they like to dig into their own details, but they don't have the time to answer every question with our software. So they rely on a team of folks like ourselves who can sort of distill and find signal in the noise and distill a lot of data sets down to a recommendation or an opinion. And that's our role within Enverus today is to really do that.
The problem is mistaking irrelevant knowledge for essential knowledge, where you're looking at something that doesn't matter. What would be an example of a data point that doesn't matter?
It's interesting. Yeah. One that I think of that, does matter on a longer term basis, but tends to trip people up in the short run is, and there's a good example last year is the US rig count. And so last year we saw this surge in US supply in the back half of the year, and everybody was calling very confused, but the rig count is going down. How are we adding barrels? And so that's one where in the short term, the rig count actually is kind of irrelevant because the spud to sales, or the time lag from drilling a well in the US on average to bringing it on, is about 200 days. So it doesn't matter if you drop a rig today, that's going to impact your production next year. So the short-term information in terms of rig count that comes out every week, some people focus on that and expect that to impact supply very quickly. And the reality is you're looking 6 to 12 months forward in terms of the impact. And so in the near term, it's fairly irrelevant. We focus more on completion data, production data to get us a better tell on what the next few months, and maybe the rig count 6 months ago is a better indicator to the rig count today. So that's an example of, it's an important factor over the long term, less important factor over the short term.
Are there 2 or 3 data points of signal that you do focus on to try and determine pricing and whatnot? What do you focus on?
From a hydrocarbon pricing perspective, we're super focused on the supply cost curve and any changes in that. And that really helps us inform like the medium to long-term view, right? So whether that's on the gas side, where you're trying to figure out which basins are actually going to grow to meet LNG demand and at what price will you get enough growth to meet that demand, that's something we think a lot about, and it informs our price view. Similarly, on the oil side, we can focus on that in North America, and to the extent the elasticity of the relationship between activity levels and price and how that's changing. We generally believe in the last 20 years, the US has been the marginal molecule of gas or of oil in the world. And so getting smart on what the direction of that marginal cost looks like going forward is helpful from a long-term pricing perspective. And we think that marginal cost is going up, not down, which it did for the last 15 years, which is why we're more optimistic on price this go around. And then on the OPEC side, that's obviously important. They control a lot of the oil supply, and trying to understand their policy and behavior tends to move the market the most in the near term.
Are there any non-consensus views that maybe you hold or Enverus has allowed you to discover? Is there anything that you guys are thinking about that maybe you're going against the grain right now?
Yeah, I think
I see a lot of data.
There's always a lot of different views that our team, will put out on a pretty regular basis. And just for context, we have, about 30 folks that look at energy transition stuff. We have about 40 folks that focus on oil and gas. So it's a big team.
What might surprise somebody?
Yeah, I think the surprising ideas, certainly from an oil demand standpoint, we think oil demand doesn't really peak even this decade, if not into next decade. That's certainly on the bullish end of folks' minds. When we look at the oil patch at large across North America, we probably see, assets like CNQ's mines as some of the highest quality assets in North America, like for like with kind of core Midland Basin returns and core Delaware Basin returns. And that's sort of, I think, still not fully digested by the market at this point. There's also, I think a counter consensus view is, in parts of the Delaware Basin, in a very, I would say, not the entirety of the basin, we think you could stack 50 wells a section and still make a very economic wells out of those 50 wells. That's, I think it would surprise folks in terms of just the density of development that basin can host versus a lot of other plays where you're like 4 to 5 wells a section is max. So those are some maybe interesting ones. But there's lots of different views. The fact that we think gas is going to have some time at $5 in 2026 is higher than strip and would be a big trade for an asset holder or an equity holder.
Well, that's oil pricing, natural gas pricing, inventory scarcity, capital discipline, AI, U.S. Canadian equities, signal versus noise, the wrong source of information, unconventional views. I think that's a really good sampling of your thoughts and Enverus's thoughts. If you were to leave a listener with a message on maybe Enverus or your thoughts on energy, what might you tell them?
Yeah, I would say overall, we're really excited about the future of both kind of traditional energy and energy transition related technologies. There's room for both, and we need kind of all of the above. And we've constructed the business around that thesis, that it's not kind of new energy or old energy. It's both, particularly in the more recent news of AI taking a lot more power demand and a lot more investment. We continue to be surprised to the upside in terms of how excited we are about the energy story in North America and globally.
Well, that's awesome. we can end the formal conversation there. So thank you.
Thanks, Trevor. Appreciate it.
Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca where more episodes are yet to come. You can also subscribe to the podcast where your token of support is much appreciated. Until next time, happy coffee drinking.